The $1,700 per ounce floor in the range is very significant because to me, it sets up what I call an asymmetric trade. An asymmetric trade is one where it might continue to go sideways, but you're probably not going to lose a lot of money and you could make a ton, no pun intended, since we're talking about gold. But the point is, if you got a floor at 1,700 and you've got upside up here, you don't know exactly when you're going to realize the upside, but if you can just stay with it and not get too upset about these periodic crashes, you're in a position where you've got what looks like a solid floor and lots of upside potential. That's a good trade. Again, I'm not a day trader, but timing matters and trends matter, and that's a good one. So then the question is, what's going to cause gold to break out of the high end of that band and get back to, 2070 an ounce and go further and then make its way to 3,000, 4,000, in sooner than later, but I'm not saying, next year, that soon. The answer is it will be a shock, but it will probably be a shock that none of us have on our shock list. And what I mean is the pandemic shock and economic shock, political shock, if you will, change of leadership in Germany, quite a bit going on. But none of these things has moved the gold price other than, kind of very transient moves. So what is it going to be? I guess if you use a sort of Bernoulli process, you would say it'll be something, meaning if you had five low probability, let's say you had 5 events, each of which had a 10% probability, but you had a 3-year time frame. So you say 10%, that's pretty low. Yeah. But if you got 5 of them, that's 50. And if it's 3 years, the odds of one of them happening in 3 years is 100%. So, that's just the math. But my point being, I don't know what it will be, and I don't know exactly when, but I feel that we, again, using a Bernoulli process, I think we can say with high confidence that there'll be something of that magnitude sooner than later, meaning probably, 2022, 2023, that will shake gold out of this central tendency and shoot it significantly higher. So I agree with different analysis, but I agree with Kevin's conclusion that this looks like a good time to buy.
One of the things that first of all, I completely agree with a lot of it. I wasn't trying to say that central banks aren't buying. In fact, all I was trying to do was explain why gold has disappointed over the last year. And the one kind of pushback to your point about gold's gone sideways. Yes, gold's gone sideways. But if you look at the Bloomberg Commodity Index, it's rifling to new highs. So if you were a gold holder looking, to hedge quote unquote inflation, then you've been deeply disappointed. So that would just be my kind of quick pushback to
that. First of all, Kevin, you're exactly right. Except gold is not a commodity; it's money.
Okay, and I don't disagree with you that there are at times it's different. It's the two, or even always, but I'm just saying that a lot of people bought it expecting it and to protect them against this coming inflation that we've seen. And if you go back to that August, time period, August 2020, when everyone was reaching for it, the bullish enthusiasm was awfully thick. And yeah, I did use a little hyperbole when I said it went straight down. I didn't mean that, but on a relative basis, it's been very disappointing since that point. And I think that central banks walking away was part of it. And I agree, they're back now. And I think that we end up at the same place. I think that they're back now. It's one of the underloved assets that nobody is picking away at. And to me, it's a buy.
Yeah, and I agree we're in the same place. I would disagree. Now, maybe we're on to the next topic. I'll leave this to Ronnie and Mark, but I don't see any prospect of significant inflation. Now, your energy prices are skyrocketing as Canada may do okay in the U.S., but Europe and China are going to freeze in the dark. I know that's a cliche. I hate to use cliches, but this one might actually be true. But seriously, there are going to be fatalities in the UK and elsewhere with what's coming this winter because all the misguided so-called green policies and turn off all your nuclear reactors, turn off all your coal plants. We actually need a little more CO2 to keep the plants alive, but Germany did what they did, and Putin is dialing down the tap. and we'll see what happens. So yeah, so natural gas prices are skyrocketing. Oil is not far behind. Absolutely correct, but that's not the same as inflation for a couple of reasons. Number one, it's not broad-based and persistent. Number two, I always say that if, sort of Sun's idea, if you want to understand the enemy, you have to think the way they do, not the way you prefer. And so if you're trying to think like the Fed, which can be painful, but the Fed excludes that. They look at non-core, core, and I know most analysts laugh and go, "Well, you got to get groceries and gasoline, so why not look at non-core?" Okay, but the Fed doesn't. They look at core PCE year over year, and when you take energy and food out, that's actually coming down very quickly. So I don't see the inflation, although of course you're right about commodity prices, and there's also a recursive function there. You take oil that high, you actually put the economy into a recession.